To today's roundtable. Raleigh, that was great, man.
Thank you. I tell you what, there's so much going on. I know you got a bunch on your mind today, Don. We got some great guests that are with us. We got lots to talk about. What's on the agenda for today?
We've got Garrett, we got Scott, we got Jeffrey Turnmeyer, and Scott's going to give us a bunch of stuff. He sees a bunch of trade setups, so get your pencil and paper ready. Just mark them down. He's going to tell you exactly what to do. Garrett's got, and I just read a really interesting piece that he wrote. Dimon saying rates at 6 and 7%.
I know.
I've got, months ago I said they're not going to stop, and I don't think they will. This debt ceiling debate could put a pause to it, but boy, the markets aren't pricing that in, so we're going to look at that. And then Jeffrey, that was the inspiration for the song, right? He had something to talk about while everything else is burning, while they're burning down the house, man. He's got some solutions. So let's get everybody in here. Garrett, Scott, how you guys doing?
Good. Just trying to find the button. There we go.
All right, there we go. Well, I'll leave it. I won't make any quick comments on that anyway. Where is Jeffrey coming? I imagine he'll turn up some point. All right. And Garrett, I know you got to roll it in 30 minutes. Glad to have you guys here. Scott, we're going to start off with you on some stocks, but real quick, I just got a text from my daughter who is graduating high school next Friday. Good job, Dad. She just got her tattoo and it went well. So, all right. It's got a rite of passage around here. I'm cool with that. There's a couple things kind of set up our conversation with Garrett, which I'm really, really looking forward to diving into here. Is as a quick rant, you guys, most of the audience here probably hasn't seen the news on this, may not be familiar with it, but there's this rate. Used to be a rate in markets called LIBOR. It was an overnight rate. It was a spread on the Fed funds rate, a risk-free rate, right? And general collateral rates. All these are overnight rates for money. And LIBOR during the great financial crisis, there was this huge rate rigging scandal. All the evil banks in England and in the U.S. were rigging rates and screwing investors and homeowners out of money and that sort of thing. Well, it turns out the central banks actually were the ones that did the rigging. Those guys, a lot of guys went to jail. They paid huge fines. And it just tells you who you need to trust. I just use that as an example as who do you need to trust. And we're going to talk about rates in just a second. They keep creeping higher, expectations for a rate hike. Not that it's a lock by any stretch in June, but everybody's expecting the Fed to go on a hiking course. So anyway, now let's get going. There's Jeffrey. How you doing, Jeff?
Hey, doing all right.
Good. All right. So all right, we got the preamble out of the way. Really looking forward to this. Scott, let's dive in right now. You've got, and we're just going to get to it. You've got a bunch of names you want to go through. And let's spend, maybe about the next 5-7 minutes or so doing that. And then we'll head on over to, we'll talk to Garrett.
Okay. See everything?
Yeah, looks great.
Okay. I am going to talk about some numbers real quick. Be advised, past performance not indicate future results. These are not from live trades. This is from research. So, just so that's out of the way. We've talked last time I was here, last couple times, we've talked about this stage analysis. I love it. It's been around for a long time. It's not a teaching class, so I won't go too far into it. But the idea is that if you want to get long, you want to get long in stage 1 or stage 2, meaning when it's breaking above the long-term moving average, or on pullbacks when it's already above. This stage 1 and stage 2 is where the big gains live if you're a long side trader. I have also made a variable of this. It's nothing spectacular, but I moved it out even longer. So it's not a weekly analysis, it's a monthly analysis. And as you can see, Apple monthly chart, instead of the Weinstein chart, you can see it in Apple in real life back in the .com time.
Yeah.
You want to be long here, and then you don't want to be long there. And for more recent times, there's a stock named Tesla, good up and comer. And that's kind of doing the same thing. So this stuff it's timeless. That's my point. Now, Let me go back. I put an automated strategy. I'm a quant. I put an automated strategy on it. If it breaks above the 12-month simple moving average, 12-month simple moving average, and it closes twice in a row, then you get long. There are probably better ways to do it. I'm just giving you a quant way to do it. Yep. And you get out when it closes once below the simple moving average, the 12. Okay. So you get long on 2 closes, you get out when it closes once below. Not too many rules, right? Okay. You with me? Yeah. Doing that on Tesla, since Tesla started trading, this is your equity curve. It's kind of large, which is why I put this disclaimer out here. This is the report, $169,000 if you traded a $10,000 account. Ridiculous, right? I'm only showing this for fun. Yes, it is created by that system, but that's the past and blah, blah, blah. But just wanted to show that because it does catch big wins. And also I did this system back to 1960 on the SPX, and this is your equity curve. So this simple system or way to look at the markets goes back decades. And that's a lot of 23s up there. So I'll fire my editor. Great. And here are some stocks. I started talking about Palantir a while ago, PLTR. This is a weekly chart. This is strictly stand. And I started talking about a break above 920. It had closed above the long-term moving average and it broke out. So that's another way to do it. And I'll show that in a second. But if you go to the monthly chart, you haven't missed anything. Yay. We've only had one close above the monthly. You can see this pattern. It's very Stanish, right? One more month above and PLTR could be a big winner, potentially. Okay. This one I talked about a few months ago, DraftKings, 2 closes above. Now, what if you miss it? What if you look at a stock and it's already closed 2 times? Well, you can just draw a line across the top and trade a breakout, which you could have in DraftKings. I started talking March, April. It broke above the high and it went. PHM the same, started talking about it in April. Same thing. So that's the past though. And I'm going fast, I know, but I want to get to the ones that might. CHDN, same thing. But here's Tesla. We just talked about it. Back in the day, we had our 2 closes below. There's the system at work. It went from 22 to 286, which is a decent little gain, right? It missed all the bear market. So if you have a filter that you like, it can keep you out of this stuff. And is Tesla a trade now? It is not, as you can see, right? But it could be soon, and we could see another run in Tesla. But it's just another way when you look at long-term, all this stuff, news, it's coming back. Look at these big green bars, but this keeps you out. When you take a long-term perspective, you can kind of calm down, which is what I like. I like to trade calmly. Here's Amazon. Looky. 1 close above. Amazon could be a trade in June. All this stuff.
Jeffrey, you like Amazon, don't you?
Yeah, I've actually been pretty bullish on the fact it's probably going to go retest that little high where it came up and touched your moving average there just last August. So
yep, right there. Yeah, I love that. Cool. Yeah, I love that zone. This one, I'm going to buy it in my own account someday. It's not there yet, but it's the typical pattern. When it closes 2 times above, I love this. It's an ETF that has all the online retailers in it. I'm just waiting for this one, but I buy ETF is one you can wait for. If online retail ever comes back, probably will come back. Berkshire Hathaway has just been a buy, but you could probably get it on a pullback, right? The robot would have bought it here, but a breakout above this level or a retest, you could get into Berkshire Hathaway. You could be a Warren Buffett person on a pullback or even buy it now and buy and hold it, but it is a buy. Berkshire Hathaway is a buy. Here's NEO, almost done. NEO, same as Tesla. I mean, NEO is a monster when it goes from 4 to 37 back in the day, back in 2020 when it closed 2 times above. I mean, this is one that I have my eye. I don't love the company necessarily, but man, it moves. People like to trade NEO. Very controversial. ARK, A-R-K-K. I mean, it was okay to trade it, not to hold it, but to trade it. You would have missed all the bear market and it's closed once above. ARK could actually be a trade in June. Crazy.
So this one, two closes above, right, is what you're waiting for. So
yeah, and we only have 1 there, right? Yeah, 2 in a row, not 2 total, 2 in a row. You got it. Okay. You can do anything you want. I'm just giving you what I
sure. No. Yeah, that's right.
Carvana, this is a terrible stock. Nobody should ever buy this stock. However, it's the pattern. And if it ever comes back, it hasn't closed yet. But I mean, I'm just throwing that out there, right? It could be a couple months away, but could Carvana make a comeback? This one, nobody should ever trade this in their right minds, but I'm long in this. I got a signal and I'm long in my own accounts. I don't recommend anyone else doing it. I'm just showing it. It was 2 closes. And then beginning of this month it was a buy and I'm up in it. And this is QQQ, much more reasonable. Same thing. It got 2 closes above and it's a buy. I mean, you probably need to wait for a pullback on that one. And last but not least, is SPY a buy? It kind of is, right? It just became one this month and has pulled back a little bit. This is a very recent chart. I made this today. So you're kind of, you can buy a breakout and maybe even do SPY if you wanted. So that's it. That was a quick rundown of a bunch of stuff.
Oh, no, that's awesome. That's awesome. And yeah, the S&P, apart from a near-term pullback, personally, I've been looking at either through the summer or in the fall, we could be headed quite a bit higher. And that's just what my volume profiles are telling me. That's ignoring what's going on in the economy and the banks and everything else, right? But the technicals tell you a different matter, and markets and the economy are not exactly related. So that's great. All right, Garrett.
Yep.
Let's talk, man. Jamie Dimon says rates are going to 6-7%. I don't doubt that a bit. Though, okay, of course, the debt ceiling crisis has a debate has a lot to do with that too. But
sure.
why don't you kick it off here, man? What do you think are the implications and some of the knock-on effects of such a significant move? Because that's not anything, nobody. As far as most market, nobody wanted to even think about. I read your piece. You're right. If they mentioned 7% interest rates on CNBC a couple months ago, they would have got your tape mouth shut, right? Or mouth tape shut.
Yes.
So I love that line. But now you got Jamie saying it, so I guess it's okay. That's the Overton window has expanded, right, on rate discussions.
Well, one of the beautiful things about this market when it comes to the media cycles is how predictable it is. And if you go back to November of 2021 and you look at the cycles we've been in through, last week, everybody was bullish as bullish could be. And everybody was talking about AI and the shorts were getting crushed and all the chatter about over-leveraged funds being short. And boy, how the narrative shifted 3 days after everybody got bullish. It is the same thing that has happened over and over and over again, going back to January of last year, January 28th of last year, the April 6th period last year, where everybody got bullish and then the whole thing sold off for 6 weeks, June 8th. Big sell-off, largest sell-off of hedge funds. And then last week, as I was saying, it was very curious to me that everybody was saying, I'm bullish about AI for the markets. And just the one thing I want to point out, do you think that AI is going to be such a significant impact on this market? You had Steve Cohen talking his book last week ahead of NVIDIA earnings. That's a little curious to me that they would be pumping this stuff up. And last week, they had an AI expo. And this expo featured Ford and Pepsi and all these other S&P 500 companies. And if Goldman Sachs' report about how profitable this would be for companies was so true, why is it that only 8 stocks have moved up on AI? That is the narrative of this market. It is when everybody gets bullish and you start looking at a support level, a high support level like last August when we were at 4,300, you go the other way. And we had our signal go negative yesterday. So I'm sitting in SOXS right now. I'm shorting semis. I'm shorting virtually everything that I can get that isn't nailed down. And anything that would rely on government subsidies or government spending, particularly the solars, they're getting killed right now. Now, as you look out into the longer term, this perspective, now you have Dimon come in off the top rope and say 6 or 7%. And also, if you haven't noticed about JP Morgan, it was just a few weeks ago that JP Morgan was calling for anyone who was shorting banks to be prosecuted. And now within the last 24 hours, they're saying short the small caps. So you can effectively go to jail for shorting the banks. But if you dare short the economic engine of America, which is the Russell 2000, that's all good. I mean, that's just kind of where we are. So now you start to chatter about what's happening with the debt ceiling, and you look at the current status of this market, and you look at kind of where we sit. Obviously, my trend is to the downside in the short term. I still remain relatively bearish on the backside of a debt ceiling. I think it's going to be a big sell the news event. That does not discount the fact that as we look at the current status of this market, we still have a lot of concerns about inflation. The Federal Reserve has a perfect thing that they don't want to do, because the case study of what you do not do in this environment right now is the United Kingdom. The United Kingdom has extremely high inflation. Food inflation is at 19%. They look at that as a G7 nation and they say, we've got to drown this out. So what I continue to tell people is that even though the markets will get away from what the central bank is saying and saying, oh, it looks like everything is okay, that is a market that has been designed over the last 18 months to sell into strength and then to buy on weakness at the bottom. There's a lot of money to be made in oversold conditions and then buying at the top and telling everybody that the market's going to continue to rally. Final point on this very subject, 6 to 7%. What does that look like? Well, we completely discounted the fact that we were going to go to 3.5%. Then we discounted that we were going to go to 4.5%. Everybody said we were nuts to go to 5%. Now we're starting to see 5.25 in June. And every single person in the Federal Reserve has repeatedly said we have to go higher. And for some reason, people in this market don't want to believe them. And when they tell you this, listen to them. When they tell you that you're going to ease or they're going to cut or they're going to buy assets, that's where you go hand over fist into the market. But when they are telling you that they are going to raise, remember, in these environments, using technical analysis and fundamental analysis and just understanding that cash is a position. Cash is a position. And as we start to look out into the summer, if we were to get up to these levels, if you are liquid and you have capital, you are going to be looking at the potential for some life-changing, if not generational buying opportunities.
So how low do you think this thing will, what's your downside target on the S&P?
I think the bottom of the S&P 500 was in October. And my view on that shifted largely because 3,500.
3,500. Okay.
Yeah. So I think we can get back to 38 or maybe 37.50, but there were 4 massive pivots that happened back in October and nobody paid attention. And it was the Bank of England pivot. It was the U.S. Fed's change on mortgage-backed securities. They haven't really been selling mortgage-backed since. And that led to a 100% rally on the home builders out of October. Everybody missed it. Then you had the Bank of Japan easing, and then you have the situation with the People's Bank of China. So it's very hard for me to get back into the 3,500 level, just simply because algos have been defending oversold conditions over and over and over again. So even if you get down to 3,800 right now in a week and a half, you're going to be back in RSI, MFI down in the 30s. And that has been where people are buying the dip. And then we kind of repeat this entire process of things moving higher. And I think that can happen a couple of times, that ultimately it'll take us through the end of this crisis. And then ultimately we'll see the Fed, trying to make the efforts that they need to make in order to pivot. But it is going to likely see higher interest rates as a result. And the one thing that we've said about higher interest rates, you have to go back and you look at some of the things that have happened over the last 18 months. When interest rates move higher, the pressure is on two or three places. The first is in tech, right? Because you have to have a valuation kind of reset on expectations. Second's venture capital. And venture capital already had a bad enough situation last year where blue skies turned into dark skies, and now you're watching their banks collapse out in California. But the hurdle rates of venture capital and the hurdle rates of a lot of these companies that rely on government subsidies or are trading at 10, 15, 20 times sales, those hurdle rates start moving to 12 to 15%, and they can't justify themselves in a high interest rate environment. Yeah, no, that's great. So I've a couple comments on that. I've been looking at 4,000 as pretty decent support, although I can definitely see 3,800, and we keep resisting this 4,200, and that's looking at it to hold through the end of the summer, but that kind of range bound, I don't think we'll get back down to 3,500, again in this cycle. The interesting dynamic here with this debt ceiling, right? So let's say it gets raised, and then the Treasury goes out and immediately issues $1 billion worth of Treasury, correct?
Which it needs to do, or whatever that number is. That sucks a ton of liquidity out of the system right there by its very nature, right? It takes money out of excess reserves, out of the banking system, and it puts it right back in the treasury, right? So that's inherently that's an easy negative for the S&P over the near term, right?
It's effectively 700 billion to $1 trillion would be effectively the equivalent of a 0.25% interest hike.
Yeah,
right.
Exactly.
The numbers,
right. So
the numbers I have on that are about.
Tightness. Oh, go ahead, Jeffrey. Sorry about that.
I was going to say the numbers I have on that. The Treasury is kind of like really running on low reserves right now, and just to refinance themselves back up to the standard level, they're going to have to sell 1.2 trillion in.
There you go.
In Treasury bills.
Yeah,
1.2 trillion. So that takes 1.2 trillion of liquidity right out of the market, and they're probably going to do it to the tune of about 50 billion a week for however many weeks that takes, and to get back up to that level.
And where the T-bills right now? Anybody got that handy?
Short term, you're a 5. Well, I think it to me the
5,
question.
5.3?
Yeah, the question is where the money comes from, because a lot there is a good assumption that it would come from people who've been buying NVIDIA and Meta and made 100% on their money, and they're going to transfer money out of the S&P. But you've got $2.2 trillion in money markets. Yeah. So that capital, that's the question, is the short-term debt going to move to 5.6, possibly 6% to attract that capital out of the money market system, or are you going to see capital flow out of the mega cap stocks? And I honestly don't know the answer to that.
Yeah, you know what I could see on that? I don't see a retail or like a mutual fund participation on that, but I do see money going out of deposits flying more into money market funds, and money market funds sopping it up, right?
Yes.
It goes primary dealers buy the balance. Then it goes to money market funds to invest all the money that continues to creep out of deposits, and this kind of gives them an impetus for that. So, I think we're absolutely the debt ceiling one way or the other. We're looking lower. Might have that buying opportunity, Scott, on that SPY once it gets back down to that level, but. It's definitely a near-term bearish feel right now in the markets. Well, that is great. I love it.
The last thing. I mean, we're going to start looking at possibility of investment grade ETFs of bonds and investment grade bonds trading 7-8%. Mm-hmm. And the way you have to look at some of this stuff, if particularly this ETF, is either we're all going to get rich, or the entire thing is just going to completely break down. And the way that I choose to view it is I'm just going to err on the side of caution and say this is an opportunity to get rich. And back in 2020, when the COVID crisis was happening and everybody thought the world was ending, I remember looking at Amazon at $1,500, and I backed up the truck and I said, either the whole system breaks down and we're living in Mad Max world, and then at that world, who cares about the equity markets, or this stock is going to double, if not triple, my money. Yeah. And with some of these things, remember, bond opportunities, ETF opportunities, this is the time that you got to start to build your cash hoard and think about being aggressive for the long term, 18, 24, if not 36 months. These things pass. It's going to be a little chaotic. But go back and think about what worked in the 70s, REITs, energy, commodities. There's a long-term bull case for these things, and you don't have to, try to time things over the next 24 to 36 hours.
Well, that's great. That's great. Awesome. Thank you, Garrett.
Yeah, thank you.
You gotta run. If you stick around for a little bit, I know.
Yeah, I got to head out in 7.
But that's great. So, Jeffrey, all right.
Yeah.
Let's. So you missed the opening song, or the site, which was "Burning Down the House." That was inspired by your comment.
Yeah.
Okay, let's talk about what I have always considered to be the poison pill for an overreaching state. So here.
Yeah, I brought this. Everybody talks about credit and fault swaps and the Big Short, and how people made tons of money the last time the banking system kind of blew up, and we didn't even have the government potentially going to default. I mean, Obama on a hot mic said never. What was it? Don't underestimate Joe's ability to things up. If you don't believe me, go Google it. It's out there. But so Joe may sit on this thing until we burn it down. it's a real possibility. The credit default swap market definitely pricing a default on the fiat system. And so what does that mean? I was kind of new to credit default swap before the last financial crisis. I'm sure a lot of people in the crowd, you hear the name, you hear that on the news, what the heck is a credit default swap? So if you borrow money from somebody, that's credit, right? Somebody's extending credit, somebody's borrowing. Now, a default on that credit, we all kind of understand that. You don't pay your bills, you default, right? Now, for people that lend money to other people, a way to insure against that default is to buy what we call a credit default swap, a CDS. Now, as I said in the Big Short and the last great financial crisis, people made a killing on some of these as housing and banks burned it down. Now, how much do we need to insure the fiat system of the US dollar? The official numbers that we're borrowing, 31.5 trillion. But if you include total liabilities of the Social Security Administration, Medicare, all the unfunded liabilities, we're talking about adding another $181 trillion to this debt with unfunded liabilities. So we're looking at $212 trillion of debt, and that's with a T, trillion, out there in the fiat system based on the US dollar. A 5-year CDS costing around, round numbers, Garrett may have more accurate number here, but about $35,000 to insure $10 million worth of risk right now, just in round numbers. So multiply that by four to cover a 20-year span. And we come up with about $140,000 to insure $10 million of default risk. I mean, okay. So let's extrapolate that out. Now, to dividing 212 trillion by 10 million, that gets us to roughly 2.98 trillion to insure the US dollar fiat system. All right. So Bitcoin currently valued at about 509 billion of market cap. So if Bitcoin, something that's not tied to fiat really, was valued at 2.98 trillion just to insure, just for the insurance, we're talking about 6 times the current value. Now, suppose that the whole fiat system burned down in the next 20 years. Bitcoin's valuation would have to climb from 509 billion currently to about 212 trillion to encompass the entire US dollar fiat system. That's roughly 416 times the current value, or rough numbers, $11 million per Bitcoin if it took over. Now, I'm not saying this has happened, but at the current $27,000 price, maybe you add a couple of, Satoshis to your wallet and hold them for the long term just to see if this thing burns down. I mean, it's a heck of a potential, may never play out. I may be completely wrong on this, but it's something that could sit out there and be a risk and a potential benefit in the market. So any thoughts on that from the people here?
So I like this thesis, and I like the way that you've approached this from the valuation of the U.S. fiat system, and you can look at the global system, which is infinitely larger. But the one thing, what's an interesting statistic is to look at the size of Bitcoin and then how much would be per citizen of the world. Yeah. And I think it's only like $300, $400. Yeah. So if you own 0.25 Bitcoins, you are effectively owning right now the buying power of 30, 40 people in the future. And exactly. So there's a lot of different approaches to this. And this is one of the more intuitive ones as well, is to look at the size of the fiat system, which is clearly under duress.
Yeah, and I feel like this is an opportunity just to put this in your back pocket. Just put a few $100 into it, and if the fiat system were to blow up, like we keep printing liquidity in the fiat system, you can't print money in the Bitcoin system. It's just
Jeffry,
insurance.
It's always been, always has, and always will be, an excellent form of insurance, right? I mean, the debates around is it money or not are kind of absurd, right? So whether it's purely a store of value that off the back of it facilitates a lot of trade and transaction, it is as immutable as the math behind it, right? I mean, it's 100 without, in the absence of 100% growth, grid shutdown, right? But I've heard scenarios where you can verify the Bitcoin blockchain with a ham radio. So there's that. But no, this is, I mean, and this is every bit as much as gold is, as far as a hedge against all of this, the nonsense, right? The nonsense has been building up for over 20 years and has really accelerated over the last 10, right? And now we're just in high, going light speed. Unlike anybody that's read my stuff knows that I am absolutely not at all constructive, right? I think it'll all fall apart without a Mad Max scenario, but all falling apart meaning that there's that's the old system, right? New systems emerge, and usually for new systems emerge, the old system has to die. Just like old professors have to die in order for new ideas to move forward in academia. Old systems have to die, and that's what we're seeing. We're seeing the death of the old system. It doesn't mean the end of everything. It just means the beginning of something new, and cryptocurrency is as much a part of that as AI, fundamentally changing the workforce, and small modular nuclear reactors, helping replace the energy grid, and the vested interest that threatens. All of this stuff is a threat. That's those nerds and those dorks in Congress wouldn't be so crazy about Bitcoin if it wasn't such a legitimate threat. I mean, they see it as a threat. Commies need fiat money to get their agenda through. Absolutely, they absolutely need free state-run money to get their agenda through without the spending. That's why Biden is absolutely not looking at a cut, and he only wants to freeze it, right? Because they have to keep the goodies going, right? Without all of that, the entitled state would collapse. You can't support it. You fix the money, you fix the system, right? And this is one way to fix that. This is one way that the money system will get fixed, right? It's going to get fixed, and this is how they're going to do it, man. You gotta pick up a Satoshi or two. I mean, it's easy insurance, and it should just be a buy and hold hodl. Just pick it up, over time. That's what you got to do. You got to build a base just like you would build in gold.
Now, you want me to roll into the other opportunity I have for crypto?
Yeah, let's see it.
So I want to thank everybody for joining us today. But before you go, I have something critical to share with you. See, in exactly 2 days, a Bitcoin profit window opens up, which is a period of time where Bitcoin is essentially forced to go higher on an end of the month rip based on the smaller time frame. We were talking about a 20-year time frame, but now let's focus on a smaller end of the month time frame here. If it's anything like the past few months that we've seen this year, October, we saw 73% gain. November, we saw 55%. December, 29%. January, 60%. February, 38%. March, 63%. April, 163%. What might we see here at the end of May? Time is going to tell. Now, you're probably thinking, great, but I don't trade crypto. I don't want to really go get a wallet. I don't want to buy Bitcoin. And if that's you right now, then you really can't afford to miss out on the special message I have today, because Roger Scott and I what we're going to show you here in just a few minutes is a loophole for you to target your slice of this crypto pie without even touching a single risky coin. No Dogecoin, no Bitcoin. I mean, you don't even have to get into the coins. That means you can skip the hassle of a Coinbase account or, whatever, Binance, or, you don't have to worry about those things blowing up like FTX or, Sam Banker fraud, none of that stuff. You can bypass the expensive fees, the hard to remember passwords. Don't even need a wallet, because you can trade. If you could trade the stocks in a regular brokerage, I think most of us here probably know what a regular brokerage account is. Like Webull, Robinhood, E-Trade, TradeStation. That means you can take advantage of this little known loophole today. So buckle up right now. Couldn't be a better time to discover how to supercharge Bitcoin gains, because the trade starts this Friday, straight from your regular brokerage account. Just go to jeffreytrader.com/RT, click the link in the chat so Roger and I can show you our presentation and how it gets done. All right.
Awesome. All right. Well, yeah, you got to hop in there, guys. You guys see Raleigh's dropping the links in the chat. It's definitely worth your time to check it out, see what Jeffrey and Roger have to say. There's there's complicated ways of doing things and there's straightforward ways to do things. And, it's no different than, if you were buying gold through PHYS, the physical silver trust, right? I mean, there's simpler ways to go about these things, and he's got a way for you to do it in Bitcoin. I definitely encourage you to check this out. So Jeffrey, now Bitcoin, I mean, you've got all these month-end cycles. What do you kind of think is going on there?
Well, really to kind of spill the beans a little bit, there's a monthly mining cycle. We've all heard of like Marathon Digital Holdings and Riot Blockchain and, some of these other large international Bitcoin miners. Well, they go through a cycle where they have to pay their bills at the end of the month. And right now in the Bitcoin, on the blockchain analysis, it's showing that those mining accounts are liquidating 100% of their monthly mined Bitcoin to pay their bills. That creates an artificial drop in the price of Bitcoin toward the end of the month. And what I've done is uncover a way to take advantage of that without ever touching a single Bitcoin.
Right. All right. No, their cost of, their revenue has come down quite a bit from the salad days, right? So they're having to sell everything they pull out of the ground, so to speak, to keep the lights on. But there's a lot of incentive. I mean, it's a lot better than it was, a month or two ago. But that makes a lot of that sense. So anyway, that's great.
Just the electric bill is estimated to be between $20,000 and $30,000 for one Bitcoin. Yeah. So if the Bitcoin price is at $27,000 a coin, that means we're barely breaking even right now. So.
That's amazing. So I think while we're talking about Bitcoin, and so you just, and it's so hard for, a layperson to figure out what's what, but you hear a lot about the energy intensity and the wastefulness in Bitcoin, but there is no industry on earth that is as green and efficient as Bitcoin. I think it's around 60% renewable energy right now. And, as far as economics goes and the incentives to advance energy production techniques, right? I mean, if somebody's going to figure out fusion, it's going to be funded by Bitcoin, right? It's going to be funded by Bitcoin miners.
Everybody says this thing right here doesn't generate any energy expense or whatever, but the U.S. government is, the power and authority of the U.S. government is what backs that. We spend gazillions of dollars with the military defending our interests around the world. The jets flying, the helicopters. There's nothing green about this greenback right here.
And banks. Just think of the entire energy edifice, right? To run the server farms that secure the banks, to drive people back and forth into the office, right? All those bankers flying around and doing their stuff. I mean, that is all necessary and an important part of the cost of figuring out what's the energy cost of the U.S. dollar. I mean, those arguments are so absurd. They're thrown out by people that view Bitcoin as a threat, and that's the political class, right? So, get on the side of good. Buy some Bitcoin, for God's sakes.
or just come watch my replay and figure out how to do it without actually buying Bitcoin.
Yeah, that's
take
right.
advantage.
That's right. Well, that's what I mean. You're still getting on the side of good, right? Buy Bitcoin or figure out a way, figure out this loophole. That's great. Jeffrey, I really appreciate you being on here. Scott, thank you very much for taking the time. Garrett had to run. He had some things he had to do at 11:30. But everybody, you see all the links down there. Figure out listen to what Jeffrey has to say. You've heard him here. You've heard him on Roundtable. You know he's a really smart guy. And he really takes a hard look at these things. Always appreciate his perspective. And yours too, Scott. Thank you guys. Thank you guys for being here.
Of course.
All right. Thank you, everybody. All right. Hey, just as a quick comment, I would encourage a few people to definitely listen because there was some fundamental misstatements in value. So in the comments section. In the chat section, I'm not going to name any names, but I encourage a few guys to get over there and if the dollar goes worthless, that does not mean there's nothing worth buying in Bitcoin. It's not worth buying dollars in Bitcoin, but certainly you can buy bread and everything else. So just think about that fundamental value proposition. Anyway, all right, guys, check it out. Thank you much, and Raleigh, appreciate all your help.
No problem whatsoever. Glad to be here, guys. I think that was a fantastic session. Absolutely fantastic. I just grabbed the screen here for a minute. We're going to hang here for just a little bit, guys. Once again, what a great session with Don and his special guest, Scott Welsh, Jeffrey Turnmeyer, Garrett Baldwin. Like I said, every Wednesday, beginning of the day, we bring together these great minds. They discuss current events and share some pretty cool ideas on how to take advantage of the kind of volatility we see in the market. What you're looking on the screen right here is if you go ahead and click on the link to Jeffrey's trade session that he's got coming up, this is where you go. It's real straightforward. You just put your email address in there and register, and you're all set up to listen to Jeffrey and Roger Scott talk about this very, very interesting and intriguing way to take advantage of the market, something that happens with some regularity right at the end of the month. I'm going to be there. I'm looking forward to learning more about that. And with that, folks, I'm just going to leave that up. I'm going to play a little bit of music to send you on your way today. I hope you all had a great time, a good Wednesday, and a terrific rest of your week.